All right, good evening to all of you. Great to see you guys this evening, and I hope you guys had a fantastic start to the new year 2024. So this is our first monthly stock market update webinar that we are doing on Zoom for the new year, okay? If any of you can't hear me clearly, please let me know in the chat box, okay? Okay, so last month in January, we hosted a physical event on the 2024 stock market outlook, right? So during this stock market outlook event, we shared about our perspectives as well as our insights on how investors can be navigating the markets in the upcoming year ahead. And it was truly great to be able to meet up with the community, right? To do this sharing in a physical setting. And this also opens up more opportunities for us to be able to interact with you guys in person. So we hope that in the future, we can bring more of such events to you as well, okay? Now, but for those of you who are joining us for the first time tonight on Zoom, allow me to just do a very quick introduction of myself, right? I'm Hazel, the Chief Trainer at the Joyful Investors. And what we do is that we focus on sharing valuable content that empowers individuals who are on this journey towards financial independence and retire early, right? So from things like how to foster a positive money mindset to offering insights on the stock markets as well as some of the investment strategies, we hope to be able to equip our community with the necessary knowledge as well as tools that you need to make more informed investing decisions along the way, okay? So if you guys want to learn more about some of the content that we create on the various social media platforms, you can find us on YouTube channel where we do video sharing to cover on the essentials of investing as well as some of those investing concepts, okay? And we are also on Instagram as well as TikTok, where you will be able to see more bite-sized finance and investing tips that can help to smoothen your learning curve in this journey. Now, then for more timely updates on the latest market happenings, that's where you can go on to our Facebook page or to follow us on our public Telegram channel because we'll share from time to time some of our insights on the latest market events that are happening. Right, and alternatively, you can also follow us on Threads as well as Investing Note, where you will see a more lighthearted side of us as we continue to share with you on the stock market as well as personal finance tips. Okay, so this evening, we are back on our monthly Zoom webinar sharing sessions where we talk about some of the recent events that happened and to do a very quick market update as well as share with you some of our insights, right? So usually this kind of such sessions, I will try to keep it short, preferably within about 45 minutes or so, so that, you guys, after a long day of work, you can have a good rest tonight, all right? So do join us on time if you're able to on such sessions. Okay, before I begin, just a quick disclaimer. Anything that we share in this webinar, it is based on our personal opinion, okay? So it's more for educational purposes and it is not a financial advice. So before you make any investment or trade, please do your own research and due diligence, okay? Now, here is the overview of what I'm going to be sharing with you guys tonight for the market update for February. We'll first start off with the US stock markets first, okay? With a robust rally that started since last year, October, okay? And as well as this momentum that's driven by the AI trend right now, what can we reasonably expect for the US stock markets, right? Is this current rally sustainable or could there be a correction on the horizon? Then after which we will then move on, shift our focus to the Singapore REITs market, right? Because in the Singapore REITs market, we have actually witnessed a loss of momentum in the late 2023 rebound, right? And right now there is this renewed downward pressure on the Singapore REITs market, right? So is there light at the end of the tunnel for Singapore REITs, okay, amid this ongoing market decline? So these are some of the things that we're going to be covering tonight for this market update sharing. Okay, so let's begin on the US stock markets first. So let's take a look at the S&P 500 index first, right? Using that as the overall benchmark for the US stock market, what we saw was that last year we had a very good performance for 2023, right? We had a robust 24% return in 2023. And after which the stock market, in fact, it continued to rally out higher. It continued to surge higher on this upward trajectory into the new year. And recently, it has actually already surpassed this 5,000 level for the S&P 500, right? So this stock chart, I took it as of 18 February. So in fact, right now, it's not 4.9%. I think it's slightly even higher really. Okay, so in this just first 2 months of rally, right, in the new year, we have already experienced about a 5% rally for the S&P 500. Okay, so this surge in the stock market, it has likely further, ignited enthusiasm among some investors, right? Which prompted increased buying activity in the stock market, right? As this share price climb higher. In fact, there are some investors, what they do is the higher the price goes up, the more shares they buy. Okay, that's what they usually do. Now, on the other hand, there exists another group of investors who are more cautious, right? So they approach this rally with caution, and for them, they think that, okay, it is better for me to observe from the sidelines first, right? So how can we actually make sense of what's happening in the US stock market right now? How come the S&P 500 has been surging, right? Is this a lasting rally, or would there be an impending correction that's upcoming? So for us to make sense of what's happening in the stock market and to answer these questions, we need to take a look at some indicators to give us more understanding of the likelihood of the various outcomes. Now, please note that we certainly can't predict the exact stock market movement, right? Nobody can do that with 100% accuracy or certainty. But what we can do is to look at some of the indicators that are out there, give us some analysis and idea so that we have a better understanding of the likelihood of the various outcome, right? Because in the stock market, there's no 100% certainty. Everything is about just the likelihood. Okay. So based on where we are right now, firstly, before we jump right into that, let's refresh some of the key concepts, right? So we need to remember that in the stock market, this is how it actually moves, right? The stock market never moves up in a very nice, direct straight line. You don't see something like this, right? But instead, what you see is this over here, where during an uptrend, what the stock market will do is that it will rally up first. Okay, it goes up, and then at some point in time, it retraces before it can rally up again. Okay, so at which point in time does the stock market stop its rally and starts to retrace on the uptrend? That means at which point in time does it come back down, right? Or when does this happen? Now, this usually happens when the stock market is overextended, or sometimes it's said it is overbought. Okay, then that is where the stock market, the stock prices will then stop its rally and starts to retrace down. Okay, so the next question is, so then is the stock market overextended or overbought at the moment right now? Right, that's the question that we want to address tonight. Okay, now, so just to share with you my opinion, okay, I could be wrong. Okay, my opinion is that right now the S&P 500, it is probably kind of overbought and overextended right now. Now, why do I say so? Let me share with you some indicators that tells us so. Okay. Now, firstly, the first one over here is this thing called the Fear and Greed Index. Now, if you take a look at the Fear and Greed Index, this screenshot, I took it back on 15 February 2024, right? We were at the extreme greed level, okay, extreme greed region. Now, in fact, not just 1 week ago, but we have been hovering around this greed and extreme greed region since December last year, right? If you look at this portion over here, right, since December last year, in fact, we have been hovering around that region. This indicator, it works as a contrarian indicator. So what do I mean? Now, let me explain further. So what happens is that during a stock market crash, Okay, let me clear the drawings first. Okay, what happens is that during a stock market rally, what happens is that most investors, they tend to extrapolate the stock market rally, right? And they'll think that, okay, this stock market rally, it will never end. It will continue to go up. So first month it has gone up by 5%. Next month it's going to go up by another 5%. By the end of the year, I'm going to earn 12 times 5%, things like this, right? So they tend to extrapolate a rally and think that it will never come down. Now, but the way we use the fear and greed index as a contrarian indicator is that when the markets are at extreme greed level, it is usually an indication that the market is overheated and it may be poised for a pullback soon. Okay. Then on the other hand, when this fear and greed index shows that we are at the extreme fear level or the extreme fear region, that is usually an indication of a rebound for the S&P 500, right? So although most people will extrapolate the crash, but that is usually an indication that perhaps we are near the bottom, okay? And there could be a rebound for the stock market soon. So let's check out how this fear and greed index have actually worked over the past 1 year or so, okay? So take a look. On the left, this is the fear and greed index screenshot over the last 1 year. Then on the right is the S&P 500 stock price performance over the last 1 year. So back in this period over here, right? This period over here, which was in July last year. So the fear and greed index showed that we were at the extreme greed region, okay? So around here, this is July. So at the extreme greed region, what happened to the S&P 500? You see that the S&P 500 actually went through a correction over here. So it went down, all right? Then in somewhere around October last year, right, we were at the extreme fear region, okay? And in fact, that was actually the bottom of that correction, and soon the stock market actually rebounded up. The S&P 500 rebounded up from the correction. Okay, so this is an example showing you how the fear and greed index has worked over the last 1 year as a contrarian indicator. Now, if you have any questions along the way, you can just type them in the Q&A box, okay? Now, for those of you who are seeing this for the first time, right, and you are wondering, okay, how come this indicator can tell us all this information, right? How do they actually assess the level of greed, the level of fear in the stock market? Now, what they do is they actually derive this level of greed and level of fear based on a number of key factors. For example, they will take into consideration of the market momentum, right? Which they will look at whether the S&P 500, it has been constantly trading above or below the moving averages, right? They also look at things like the stock price strength, okay? Which takes into consideration by looking at the number of stocks that are at 52-week highs versus the number of stocks that are at 52-week lows, right? And some other things are like, for instance, they also take into consideration of the call and put options, right? The ratio of the put versus call. So if ratio of put versus call is rising, if this ratio is rising, it is usually a sign that investors are getting more fearful, okay? And vice versa. So these are just a few of the many areas that the fear and greed index takes into consideration to come up with the level of fear as well as greed that we are in right now. Okay, so the first indicator that we look at is the fear and greed index. Now, secondly, if we take a look at the stock chart directly, that means take a look at the S&P 500 stock chart directly, we will also notice that there is some bearish divergence for the RSI indicator, okay? So RSI stands for relative strength index, right? So there is some bearish RSI divergence. Now, what do I mean by this? If you take a look, the top portion shows us the S&P 500 share prices, whereas the bottom portion is the RSI. Okay, so for the top portion, since December, this is somewhere around December, you can see that the S&P 500 share prices have been making higher highs, right? So it keeps on breaking its new all-time high. Okay, whereas if you look at the RSI, you can see that the highs are actually getting lower. So I've actually connected it and draw an arrow over here. So you can see that the arrow, one of it is upward pointing upwards, where the other one is downward sloping. So in other words, there is this disconnect between the share price movement and the momentum that is indicated by the RSI. So this usually suggests that the upward momentum in share price, it is weakening. Even though the share price continues to climb up, but this upward momentum is weakening. So it could be an early indication that a potential pullback in share prices may happen. All right. So again, let me illustrate to you some past examples that have happened using this RSI tool. Okay, so for instance, let's focus on the first red color region over here. Okay, let's focus on this first. Now, this was back in late 2021, right? Before we started the year, heading into 2022. So back then, you can see that the S&P 500 over here, actually, they are actually making higher highs, right? So this arrow is actually upward sloping. However, if you look at the RSI, the highs, right, were getting lower. So there is this divergence, okay? And soon what happened is that the stock market actually declined. Okay, so you can see the stock market crashed after that. Now then, in July 2023, again, as the S&P 500 goes up, you see that there is this bearish divergence, right? Where the RSI is coming down again. And after which we actually experience a correction in the S&P 500. So right now, we are over here at this juncture, okay? So there's this divergence once again. So could the S&P 500 do a pullback soon? Possibly, right? There is some likelihood that it may be happening based on the RSI bearish divergence and together with the fear and greed index that we shared earlier on. Now, but do bear in mind, right? As usual, there is no 100% guarantee to all this analysis. Okay, whether it's technical analysis or any other indicators. Just like there's no 100% guarantee in any type of investing methodology. Okay, but I'm just sharing with you a possibility that that this pullback may happen because the stock market right now, it is actually overextended and overbought really. Okay. Now, so the next question then is that how deep can this pullback go? Right? How deep can it go? If it happens, right? If it happens, how deep can it go? Now, of course, we cannot predict 100%, but one tool that can help us to give us some guidance is this tool called the Fibonacci retracement tool, which I have also shared a number of times in my previous Zoom webinars during the market update sharing. Right. So how we use this tool is we just connect from the previous most prominent, right, swing low to the prominent swing high over here. You just connect using the tool, and then they will actually draw out all these levels right here. Okay. Please take note that I'm using the stock chart that is as at 19 February. So this is not the latest S&P 500 stock chart. Okay. So by doing so, these levels will come out. Now, these levels over here, they are called the Fibonacci levels. So in other words, these are the levels whereby there is a higher probability that they could possibly form the upcoming support levels in the event if the share price actually do a pullback and retrace down. Okay. But which level exactly would be the support? It would depend on the extent of the pullback that's going to happen, right? If it happens. So let's take a look. So the first level is this 38.2% Fibonacci level, right? From the peak to this 38.2% Fibonacci level, in fact, it is only just a 7% pullback only. Okay, it's actually not a very big pullback. It's not a crash. Okay, we're not talking about crashes. We're just talking about dips and corrections. Okay, in fact, this 7% is not even considered a correction yet. Correction usually we say is 10% or more. That is considered as correction. Okay, now if the stock market goes through a deeper pullback and it retraces to the next level, which is at the 50% Fibonacci level, then actually that's just only about a 9% pullback. Okay. So at this level, you can see it also coincides with the previous resistance, right? Previously, the share prices, when it hits this region, right, there was some resistance and it went back down. Okay, so this 50% it actually also coincides with the level at which there was some previous resistance. Okay, so these are just some possible support levels that may hold in the event if there is a pullback. Now, of course, this is based on the 19 February chart. So if you want the most recent one, you have to use the recent high that was formed, which is slightly even higher. Okay, but it shouldn't be too far off. Okay. So overall, let's do a summary of what we have gone through so far, right? To sum it up, right now, I'm actually of the view that the S&P 500, it is overextended. Okay, it is overbought. So it would be healthier if it can go through a correction before it continues to rally up. All right. This would then make the overall rally of the S&P 500 more sustainable over time. Okay. But please don't get me wrong. I'm not saying the S&P 500 will crash. Please don't go around saying that. I'm not saying that the stock market will crash. Okay. No, I'm just talking about a correction. Okay. It would be good for a correction to happen so that the overall rally will be more sustainable. Okay. Now, but of course, there's always a chance that the stock market can continue to surge higher, right? Because high can get even higher, okay? But nonetheless, when the stock market is overheated, what we usually do is we don't go and chase the market already, right? Usually we will wait for a pullback before we add on more positions of whatever stock that you are looking at, that you want to invest in, right? So we don't like to chase the stock market. Why? The reason is all about risk management. Okay, it's about risk management. When the stock prices get overextended, by chasing after the stock, we are actually taking on higher risk because there is a higher odds of a pullback happening, right? So we want to avoid that. So usually we will not chase the market, right? We will wait for the pullback before we continue to add up more positions to accumulate more positions of the good stocks. Right? Because at the end of the day, you must remember that one of the most important questions in investing, right, that we need to ask ourselves from time to time is, what are the chances of losing money from my investment? Right? What are the chances of losing money for my investments? Now, most investors, they only focus on how much returns they can make, how much money, how much profit I can make from my investments. But they neglect the level of risk that they take on for their investments, right? And as more and more people get excited about their investment, that's where they start to take on more risk without even knowing it. Now, however, over time, you will realize that if we can learn to prioritize risk management so that we manage the downside, then over the long term, the potential for positive returns would then be more sustainable for your investment portfolio. Now, I put in some numbers for you guys to understand this further, okay? For example, if today you own a stock, okay, let's say the stock is at $2, okay? If the stock price drops from $2 to $1, right, the amount of loss that we incur is negative 50%, right? We lose 50% on the investment. Now, but for you to go and recover back this $1, to recover it back to the original $2, the amount of gain that you need is 100%. Okay, so you see, turning our losses into profits is actually much more challenging. You need 100%, but when you lose, it's only a 50%. Okay, so it's just like, going uphill requires more effort, requires more energy than going downhill. Okay, so this is why it's very important that we want to focus on risk management to manage our downside. That means the chances of losing money in the stock markets. And if you are able to do so over time, you will realize that you are able to make more sustainable returns in the stock market over the long term. Now, in fact, right now, we have a lot of this, we have some good examples in the stock market. Because in the recent months, we have a lot of this AI frenzy that is happening in the stock market. So there are many stocks that are related to AI trend, okay, like for example, NVIDIA, okay, and many others, right? They have been rallying up tremendously over the past 2 months in 2024. Right? Some people call this the monster rally. Okay, so if you take a look at the stock chart of NVIDIA, wow. In just the first 2 months alone of 2024, it has been up by 50% already. Okay, if you are invested in this stock in the first 2 months of 2024, you have made 50% already. Okay, so because of this very attractive returns that some investors are getting, it has been fueling a lot of FOMO, okay, fear of missing out in the stock markets. Where in fact right now in the stock markets, more investors they're more worried about being underinvested than being overexposed in the stock markets. Okay, so if you take a look at the stock chart of NVIDIA, you can see that this is the recent rally in the last 2 months, and it's actually quite scary because you look at the gradient of this rally, it is almost near vertical, near 90 degrees. And when we see something like this happening, this is usually an indication that there is some extreme greed happening. Okay, where some of this buying activity, it has been driven by a lot of FOMO and hype. So some people, they are confident about the company, yes, but there are others who just hearsay from their friends and then they start buying, or they see that Nvidia has been making a lot of money in the recent months, right? And they started buying more and more. So it's driven by more and more FOMO and hype along the way. Now, at some point in time, right, mean reversion would take place and there would be a pullback. Now, how deep this pullback would be, I have no idea, okay? Sometimes it could just be, it's just a shallow correction, but sometimes it could be a crash, right? Nobody knows. So the important question to ask ourselves at this point in time is this one. This is the important question to ask ourselves. What are the chances of me losing money if I also chase the stock together with the crowd? Okay. Now, Nvidia is a great company. Yes, it's a great business. But right now, there's a lot of greed that is coming out, right? That's overpowering some of the market participants. So you always remember today, a good investment is not just only buying a good company, but you also want to pay a good price for it, okay? So that you're able to make money out of this investment over the long term. Now, some people are also wondering, some investors, they're also wondering, so with this AI trend right now, would there be an AI-driven bubble in the overall stock market in time to come? Would there be this bubble? Now, my guess is that we are right now still possibly in the early innings of this AI revolution, right? We're probably still at the early stage of this AI revolution. But in time to come, whether there will be this AI-driven bubble, that one, it really depends on how the stock market participants react to this AI trend. Now, you must remember, okay, so you see, AI, right, artificial intelligence, it is poised to revolutionize the way that we live our life, right? So, and I believe it will be transformative. Okay. In fact, right now, some of us, we have already begun leveraging on some of the generative AI tools, right, which are useful whether for work or maybe for some other things that you're doing, right, or for studies, right? Those are actually quite useful tools. And I believe that it will also create much more there'll be many more useful tools that will be coming up in the upcoming years to come, right? But as with all asset bubbles, now what is one common thing with all asset bubbles? Now, one key characteristic or one pivotal driver of asset bubbles is actually the behavior of market participants, right? It's the behavior of the market participants, right? So we shouldn't blame the asset. Rather, the root of the problem is not the asset, but it often lies with the market participants. That means the investors, right? Or whoever is in the stock market, where there is emotional volatility of market participants, right? As more and more people starts to get greedy, they start to feel FOMO for missing out on the gains. That's when they start to chase the market. That will create more and more hype. And that is where we have the formation of asset bubbles. So this is usually how asset bubbles are formed. So we don't blame the asset itself. The problem lies with the market participants, the behavior, and the emotional volatility. Okay. In fact, even for very good companies, fundamentally sound companies, they can also be subjected to speculative activity due to the investors' behavior over time. So to protect ourselves from all these asset bubbles, right, or that may come up from time to time. It's not just AI trend, I see. In the future, there might be other things as well. But to protect ourselves from the risks associated with asset bubbles, what we do is that when we invest in the stock market, we don't like to chase the market. We only buy when they retrace to certain levels, such that the risk to reward is more in favor. Okay, so this enables us to mitigate the level of risk that we take on, right? So that we maintain a more prudent investment approach. So that is how we usually invest in the stock markets now. Okay. All right, so far so good, right? If any one of you have any questions, just let me know along the way, all right? I'm going to move on to the next part, which is on rate cuts. Okay. So let's do a very quick recap of the current situation for the rate cycle in the United States. Last year, the Fed signaled 3 possible rate cuts for 2024, right? And that got the market very excited. It further propels the stock market rally. In fact, at that time, there were some investors that were initially even predicting up to 6 rate cuts happening this year, okay? Now, during our stock market outlook event that we organized last month in January, we also talk about this, right? And we caution the community that we should refrain from making impulsive investing decisions solely based on the forecast of the rate cuts. Okay. Now, the reason is this: you must remember that how things would play out in the real world eventually, it may not always be as planned. Okay. In fact, it is anyone's guess. All right. So last year, they signaled 3 possible rate cuts. So would there really be 3? Nobody knows. It could be more, it could be less. All right. Given that the Fed themselves also don't really have a good track record of their own predictions. Okay. So just recently, out in January, late of January, right, the Fed made it clear that they are not ready to start cutting rates. Okay, with inflation still running above the central bank target. So what they want to do is they want to wait first. They want to wait for more data to come in so that it can substantiate that the current inflation trend is indeed continuing. Then they will be willing to start the rate cut cycle. Okay, so initially the market was projecting that the rate cut would come in March, but right now, if you look at the probabilities, right, using the FedWatch tool, it's just a mere 0.5%. Right, the probability of a rate cut in March has fallen to just a mere 0.5%. So likely we're not going to have a rate cut soon, right? It could be the next one or the subsequent FOMC meeting. Okay. In fact, the US job market, it remains strong. There is this job growth acceleration happening in January, right? In January, a total of 353,000 jobs were filled. And this is against the expectations of 185,000, right? And this is the largest gain that you have seen over the last 12 months, right? This bar is the tallest in the last 12 months. So average wage in the US was also pushed up by a more than expected 4.5% year on year, right? So what's the lesson that we can learn from this, right? The lesson to take away is that as an investor today, we always stay true to our investing principles. So essentially, it's as boring as this. You only invest based on the fundamentals of the companies. You only want to buy the good companies, and you only want to buy them at good prices, right? So don't make your investments based on what the Fed says, or based on how high the inflation rate is, or no, based on whether the rate cut is going to happen now. Okay, do not be influenced and swayed by these noises, right? We call this the noises because they are more of distractions. Because you realize that factors like macroeconomics or factors like the actions of the central bank intervention, all these are actually not within our control. And they are not as easily predictable as you think. Right? So stick to these core investing principles. Then over time, as you continue to do that, your investment portfolio performance should show, right? And you should do fine. Now then, in terms of the earnings fundamentals of the S&P 500 companies, right? We're right now still in the midst of the last quarter 2023 earnings reporting period. So far, only about 79% of the companies have reported their earnings, and the current blended earnings growth rate is at a positive 3.2%. So blended earnings growth rate means they combine the actual results of those companies that have already reported with those that have not yet reported. So with the estimated results of those companies that have not yet reported. So this would likely mark the second consecutive quarter where the S&P 500 reports a positive year-on-year growth in earnings since we had the earnings recession back in 2023 last year, right? So overall, based on the fundamentals of the overall S&P 500 companies, it is looking actually pretty decent, and we are still overall bullish about the US stock market. Okay, but at the moment, in the short term, we feel that it is somewhat overextended, right? And a correction would be good in the short term so that it can make the long-term rally even more sustainable over time. Okay, so this is for the US stock markets. Now moving on to the Singapore REITs market. Okay, some of you guys may be very interested in Singapore REITs. Okay. Now, Singapore REITs market, is there really light at the end of the tunnel for Singapore REITs? So normalizing interest rates in 2024, right? If it happens, it could help to boost interest in Singapore REITs among the investors, right? Given that Singapore REITs, they are very sensitive to the interest rate changes, right? In addition, if you take a look at many of those REITs that we have here, they have been adopting proper capital management since the onset of rate hikes. Now, what does this mean? take a look at the debt profile. Okay, debt profile of the Singapore REITs, you can see that actually is very fairly spread out over the years. So for the percentage of debts that are going to be expiring in the upcoming year in FY 2024 is just only about 17%, right, in FY 2024. Then it is also spread out in FY 2025, is about 19% and spread out over the next couple of years. So this debt profile is actually fairly spread out. Now, no doubt, if you look at the financial performance, for example, if you look at the DPU or you look at the distributable income for some of the Singapore REITs, you have seen that in the last 1 year for 2023, some of them have been negatively impacted. So there could be some decline, right, for DPU. And the reason is because of higher interest expenses, as most of you guys should know by now, okay? Now, but this likely is going to be temporary. Okay, that means as this situation improves, as interest rate normalizes, then this situation where there's a decline in DPU or distributable income should actually turn around eventually over time. So supporters of Singapore REITs investments, right, they have been asserting that a recovery in the Singapore REITs market will happen. Now, I know that you guys have probably heard this for the longest time already now, but when would this really happen? Okay, or would we really see this playing out? Would we really see this happening? Now, unfortunately, we cannot control the stock market, and we cannot control the pace of a stock market recovery as well, right? We also cannot foresee when this recovery would take place fully, right? But what we can do is to only analyze the current situation based on what we can see right now, based on the current share price movements, to see if there are any positive signs of some recovery or some progress in terms of the Singapore REITs market. So let's take a look at the stock chart of the Lion Philippe S-REIT ETF. Okay, the ticker is CLR. So this chart again is taken as of 20 February last week. Okay, so over here you can see this is a very clear downtrend, right? It's a very clear downtrend. Even if you never learn about trend, you will know that this is coming down, right? So this is called downtrend, right? That means to say the highs, you see the peaks, they're actually getting lower. Okay. Now, if we connect all these highs over here, we have what we call the resistance trend line. Okay, this downward sloping resistance trend line. So previously, back in late 2023, right, where there was some good news about how the Fed is going to cut rates in 2024, right? And we saw this REITs market actually doing a very strong rebound in late 2023. Okay, in fact, it actually attempted to break this resistance trend line, but it failed to, and right now it has actually turned back down again. So seeing this, right, I'm pretty sure many dividend investors, they were disappointed, okay, with this rally that didn't last, that didn't continue into the year 2024. Now, so based on what we see right now for the Lion Philippe S-REIT ETF, the good news is that with the recent retracement over here, okay, with this recent retracement over here, we actually didn't form a lower low that is lower than the previous low. So the previous low is point A, but the recent low is point C. Okay, so you can see that point C is still in fact higher than A. So that means to say if in the upcoming months, if it is able to do a rebound up, okay, and it can break above this resistance trend line to form a peak that is higher than B, the previous peak, then that would be a positive development for the share price of the Singapore REITs market. Okay, that would be a promising sign for possibly a potential reversal in trend. But this is only preliminary. Okay, a confirmed uptrend, an uptrend is only confirmed if we see at least 3 higher highs and 3 higher lows. Okay, but right now we have nothing like this. Okay, but if the low, okay, the low that we have here over here is higher than the previous low, and if it is able to form a peak that's higher than previous peak, right, that would be a promising sign for the share price development of Singapore REITs market. Okay, so this is an analysis using the CLR ETF to represent the overall Singapore REITs market. Now, but of course, if we zoom in on individual REITs, you look at the individual REITs, different REITs, they are recovering at different pace. For example, you look at CapitaLand Ascendas REIT, their trend, they are in a consolidation trend. Okay, that means they are moving more to the sides. Okay, whereas if you look at, for instance, the Keppel DC REIT, Okay, it is a clear downtrend. Okay. So different REITs, individual REITs, they have exhibited varying recovery pace. Okay. And when exactly they will recover back into the uptrend, nobody can predict for sure. Okay. So what is important is that you continue to only hold on to the good companies, the fundamentally sound Singapore REITs. Okay, so despite having this sluggish performance of the Singapore REITs market, right, we continue to accumulate further positions in some of the individual Singapore REITs back in October last year, as well as early this year in January as well. So most investors are, when they see a market crash, what happens is that they like to stay away from the market crash. Okay, because of fear. They fear that they're going to lose even more money, so they're going to stay away from it. Now, but rather than being problem focused, we prefer to be more focused on the opportunity, right? Opportunistic mindset, so that we can scout for good stocks that are still beaten down in terms of the share prices. So those of you who have been following us on the Investing Note platform, which is like a Facebook but for investing community, you have seen some of our posts back in October, back in November, as well as recently, right? We have also been accumulating some positions, right? Back in October, November, as well as recently in January, February as well, during this pullback for the Singapore REITs market, to take advantage of the situation to buy more positions of the REITs that we would like to own, right? So the rationale for this is that, you see, the best time to accumulate stocks is when the macroeconomic outlook is still looking seemingly bleak, right? That's the best time to accumulate. Because why? During such periods, that is where you can buy the good companies at discounted prices, at lower prices, right? There are many investors who prefer not to do this. They prefer to wait until the macro outlook starts to get rosier before they are willing to start investing. Take, for example, some people, they want to wait for a confirmed rate cut. They want to wait for the Fed to announce that, okay, we are going to cut the rates before they're willing to start investing in REITs. Now, there is certainly no definite right or wrong approach to this. There's no right or wrong approach to investing, right? But what we must understand is that the downside of doing so is that by the time the announcements are made, usually the stock prices would likely have already rallied out. Why? Because stock markets, they are forward-looking. Okay, so which means to say that you will have missed out on the chance to buy the good companies that you want to own at cheaper prices. So ask yourself the question now, if today this is a good REIT that you want to invest in, do you want to grab the opportunity to own it at a discounted price, right? So this is actually up to you, all right? Now, but a word of caution for investors is this. Although we say, the good time to accumulate is where the macroeconomic outlook still seems, bleak. But that is not to tell you, or that's not to say you should just jump into investing in any other random REIT, or just buy the REIT that's crashed the most. Now, what do I mean by this? You see, a lot of investors, what some investors like to do is they like to go and pick the REIT that has crashed the most. The more severe the crash is, they think that the upside potential is higher. And I can tell you that this may not necessarily be true. In fact, this should not be the basis, this should not be the way in which we pick and select the REIT to invest in, right? Sometimes certain REITs, they crash more severely is because their fundamentals are lousier. That's why they crash more severely than the other fundamentally sound REITs. So do not just make your investment based on how severe the crash is, right? It doesn't mean the lower it is, the more I want to buy, or that the upside potential is higher. That's not necessarily true, okay? So for those REITs that have poor fundamentals, some of them, they may not even be able to recover back to its previous all-time high, right? Or, in the short term, the share price may do a rebound, but that might just be, a dead cat bounce, okay? So it is very important, always fall back to the fundamentals of the REITs when you are investing, when you are picking which REIT to invest in. So that over the long term, as we recover from all these macroeconomic crises, temporary crisis, right? Over the long term, you can see that the share price will then be able to move more in tandem with the fundamentals of the REITs. Okay. So this will then conclude the stock market update for the month of February, right? For those of you who want to learn more about Singapore REITs, right? You're not familiar with Singapore REITs, you want to learn how I can actually build up my passive income with Singapore REITs to build up my own REITs portfolio, the next upcoming workshop that we have will be on 3rd March, which is a Sunday. Right. In fact, it is this coming Sunday. Yes. So during this workshop, we will spend more time to teach you how you can cherry pick the Singapore REITs to invest in. So we'll go through the framework, so that once you learn the framework, you can then go back and apply it on your own, right, to build out your own REITs portfolio. And instead of just focusing on all this macro outlook, analyzing what the Fed is going to do, predicting what the Fed is going to do, we'll teach you what you should actually be focusing on instead. And we'll also be sharing with you how to buy Singapore REITs at more reasonable share prices, right? How to look at this from the stock chart perspective, something which many investors, they tend to ignore, all right? So if you're keen to find out more about this workshop, you can just scan the QR code over here at the bottom left of the slide, or you can just head over to this website, thejoyfulinvestors.com/learn, to find out more details about the upcoming workshop. So this workshop will be held physically in a physical setting. So it's not over Zoom, okay? It's not over Zoom. Then we also have other upcoming workshops lined up for you. For those of you who wish to learn how to do more in-depth stock chart analysis using a range of tools, right? We have a workshop where we'll talk more about technical analysis. So during this workshop, we'll share with you some useful technical indicators to apply. And in the first place, why do these technical indicators even prove to work over time, right? So how you can actually use them to help you to identify appropriate price levels to buy and sell, instead of just randomly buying and selling as and when you feel like it, or based on what your friends, your peers are saying, whether they're buying or whether they're selling, okay? So this is to help you, to guide you to make more informed investing decisions in the stock market. So the next session will be in April, on 7 April. Again, it's a Sunday afternoon, and it's a physical face-to-face workshop, right? So that learning can be more conducive, right? So you can scan the same QR code over here, or head on to the same link, right? And just click on the appropriate workshop that you want to find out more about, right? But in the event, if let's say you want to sign up for these workshops, but you can't make it for any of these dates, what you can do is simply follow us on Eventbrite, follow us on our Telegram channel, so that you can stay in the loop for our future sessions when they are open for enrollment, okay? Okay, so that's the end for today's February market update sharing. Right, if you find our short Zoom sharing useful, do join us for future sessions, and you can just subscribe to our Telegram channel so that you'll be notified of the future sessions, right, when we are holding this. Usually we hold it every month, unless in that month there is something whereby we are not able to hold the market update. If not, usually every month we should be holding this market update over Zoom, and it should usually be about 45 minutes to at most an hour, all right?